I'm Charlotte McLeod with investingnews.com, and here today with me is Bert Dohmen, founder and CEO of Dohmen Capital Research. Thank you so much for being here. Great to have you.
Yeah, it's my pleasure to be with you.
Yes, really good to be catching up with you once again. We are catching up from our last interview all the way back in, I believe, June. So a lot has happened since then. I know one of the issues that you really emphasized at that time was the inaccuracy of the U.S. jobs numbers that we were getting. And I wanted to pick up on that once again, because we did just get the latest U.S. jobs number, but it's after the government shutdown where, of course, we had a lack of availability of data. So I wanted to begin with those jobs numbers. Anything you would pull out, or maybe from the government shutdown situation as well?
Well, I think we're not getting any statistics now because of the shutdown of the government. But I think that's really a blessing because the numbers are so wrong and so misleading. So let's do away with those numbers and have people find the real numbers. And the real numbers come from private companies. You know, there are several companies that really publish good statistics, and they're much more trustworthy than those from the government. The numbers from the government you can never trust. We have become just like China. If you believe Chinese economic statistics, you better watch out that somebody will not sell you the Brooklyn Bridge. So we don't believe those numbers. We do our own research. And in fact, it's really interesting. The BLS numbers, Bureau of Labor Statistics, their numbers, the ones that they publish and make the headlines on TV, are seasonally adjusted. They never tell anyone how they make those adjustments. And we wrote several times and said, they probably just called the White House economists and said, what number would you like for jobs? You know, that's about how accurate it is. They're totally tainted. And to Mr. Trump's credit, he fired the head of the BLS because these numbers were so corrupt. And but who knows? I don't think they'll get much better because the government is government. It's always the same, you know, and you cannot trust what they put out. So we look at our own statistics. We look at what's actually happening in the economy. We see now reports from our clients, business owners, and so on. Their businesses are just falling off the cliff over the last 3-4 weeks. So that is a real economy. So when the small businesses start having trouble, then the big companies will follow. And one thing we haven't heard much talk about is what may be causing this. You know, and I think AI is very good. I mean, I call it technology. It's magic. You know, it's really amazing. We use it not only for search, which most people use AI for, but for actually doing projects. It's amazing how powerful it is. And that will mean that a lot of people at companies, even tech companies, will be superfluous. And we saw this I think it was about a month ago. There was Microsoft released earnings and revenues. Revenues and earnings were at new record highs. And at the same time, they said, we're going to let 15,000 people go. Really? They're at the forefront of AI, and business is fantastic, and they're letting 15,000 people go. Now, can you imagine what other companies that are not at record highs, what they're doing when they start using AI? You know, and we're just in the first stages. So the estimates now are being increased all the time by institutions of how many people will lose jobs. We said about 500,000 might lose jobs in the next couple of years in the United States. But now we have to look at millions of people will lose jobs. And now usually in technological advances like this, the last one, I guess you could say, was the dot-com bubble. There were other things that compensated, you know, like building website, building out the internet, you know, so the people just transferred their jobs, you know, from one area to another area. But this time around, I don't see that. I think the people that know AI, they will have a lot of job offers. People that don't, they will not have any job offers. There's nothing to replace it. So, and that would really raise the specter of deflation. We have not had deflation for a long time. And this is the nightmare of central bankers. The central bankers always say, we can handle inflation. All we have to do is reduce money supply growth. But we cannot handle deflation because the deflation depends, they can put the money out there through the banks, for example. But if the banks don't lend the money out, money supply will not grow, the economy will not grow. It's just that simple, and bankers will not make the loans if they don't think they're going to get the money back. It's just that simple. So that's why deflation is really the nightmare of central bankers. And if we now have millions and millions of people worldwide, this is not just US, worldwide losing jobs, this is going to be a big, big problem worldwide.
Okay, I think we've got a number of topics there that we need to pick up on. And I want to first ask you a little bit more about AI, because when it comes to AI, I've been hearing a lot about the concerns about whether there's a bubble in AI stocks. I haven't been hearing so much about the job losses that you've been going over, but are you also looking at the AI bubble angle?
Well, there definitely is a lending bubble. And, the good question is these commitments that the AI companies are making for future expenditures and so on in that area, where they're going to get the money from. When you're in a big recession, it's, even for AI companies, it's going to be hard to go to a bank and get the loan. And now we're on top of that, we're seeing the start of the meltdown in the crypto area. The cryptos are finally doing what we have been forecasting. All the cryptos eventually will go to the same price, which is a zero, which is the intrinsic value. There's no intrinsic value of anything, like the Bitcoin and so on. And that is going to cause a major calamity because these people, we just saw the prelude this month in the Bitcoin crash. Bitcoin was down 35%. In just a couple of weeks. This is just a prelude because so much leverage is used. There's nothing to say about is Bitcoin worth it or not. So it has nothing to do with that. But when you buy anything with a 3 or 4 or 5 times leverage, I don't care what it is, it's going to implode and kill the lender. I mean, the borrower. This is incredible. The leverage that is being used by some of these well-known companies. I won't mention the names, but it is really outrageous to think that these grown people, adult people, don't think that this is dangerous. Yes, we saw it. Here in just a couple of weeks, there was a meltdown. A meltdown. Millions of crypto accounts, Bitcoin accounts were closed because people couldn't meet the margin calls. And this is just a start. Can you imagine when the real selling starts?
Well, that's quite a statement when it comes to Bitcoin. So you see all cryptocurrencies eventually going to zero. Is this decline that we're seeing right now in Bitcoin, are you looking at that as the start, as that move down to zero for Bitcoin?
Yeah, but it's not going to happen in the next year. It takes time for these things. For people to lose total interest, say, okay, Bitcoin really and all these cryptos really do not have any intrinsic value. Intrinsic value is when there's something of value. What do? When you buy a Bitcoin? You give somebody unknown your money, $100,000, let's say, for Bitcoin. Okay, what do you get? You get a digital token. A number. You get a number. What can you buy for that number? You go to Safeway and try to get a loaf of bread with that number. You won't get it. You try to get beer for it. You can't get it. Okay. So what is the value of this thing, this precious thing? They call it liquid gold. I mean, what a misnomer that is. We saw it here. The liquid gold went down 35% in a couple of weeks. So it certainly wasn't liquid gold, was it?
No, I think we're probably
No,
learning that.
I think eventually, in a few decades, when books will be written about it, people will write, say, how this was the biggest financial scam ever in the history of mankind. How could people ever fall for this?
We'll have to see how this plays out. I think we'll all be keeping a really close eye on that. And I want to go back to what you were saying about deflation as well. This is the worst nightmare for the central banks. And before we turn the camera on, you're talking about this Fed meeting that's coming up in December and how people are placing so much importance on it. And you're not necessarily seeing it the same way. So what are you looking for at that December Fed meeting?
Well, they're playing games again. You know that they're trying to make people now answer. Well, maybe it's not a sure thing. Maybe the Fed won't cut rates and so on, getting people on edge. You know, it's a kabuki theater. That's what it is. You know, they know they're going to cut, and they also know it won't have any effect. Would it make any difference to a borrower if he's paying 0.25% more interest than he paid before? Huh? Would it make any difference for you? If you would get a car loan and suddenly somebody said, "Oh, I got a deal for you. It's 0.25% less interest." Would you even listen to somebody saying that? No, it's crazy. It's crazy. What matters is that the Federal Reserve is lying again. They've been saying they've been practicing QT, quantitative tightening, all year, which is such a lie. We have money supply M2 growing all year long. It's now at a new record high. We have bank loans growing, and it's now at an all-time high. You don't have those growing when there's tight money. They are declining when you have tight money. So, but there are enough people who believe this stuff.
Well, okay, and that's very interesting because the Fed has also said, all right, now QT is coming to an end. So if they weren't even practicing it properly before, and now they say it's coming to an end, what do you see happening next?
Well, the next thing is, you have to differentiate between short-term rates and long-term rates, always. Long-term rates are the bonds. Short-term rates, I think eventually, because if a recession gets too bad, like a depression, you're going to have 0% interest rates. Yeah. And so this is basically, it's the first step going to zero again, which we did have about 8 years ago, something like that. And so we're going to have that. Bond prices, a big problem for the Fed, for the U.S. Treasury, actually. The U.S. Treasury needs to sell long-term bonds. Nobody wants to buy long-term bonds. And many times commentators will say, well, it's U.S., they don't have confidence in the U.S. No, nobody wants to buy long-term bonds anywhere, not in Japan, not in China, not anywhere, because they don't trust any government. There's no government you can trust right now. They're untrustworthy. I mean, we really have the worst governments in the world, but worldwide. So what's going to happen? I think something that Trump should consider is this would be very interesting. Make U.S. Treasury bonds backed by gold. Wouldn't that be a shocker? Suddenly, the U.S. would be the only treasury bond that is backed by gold. That would make U.S. bonds the most desirable asset in the world, probably. And that could happen. But how much would you have to raise it to? Well, in order to back all the U.S. Treasury bonds that are outstanding now, you would have to raise the price to around $20,000 per ounce. So that is a good target rate to look at for gold. $20,000 would back all the U.S. bonds with gold. So I think that would, and I think it's kind of within the mentality of Trump. He likes to come with big surprises. And can you imagine the U.S. suddenly has the only treasury bond in the world backed by gold?
He does like to come with surprises, and that would certainly be a big one. And I think with the US right now, one of the issues it's having with countries around the world is a lack of trust. So do you think if they would back treasury with gold, that would increase the trust that other nations around the world have in the US and bring them back in once again?
Well, other nations would start investing in U.S. Treasury bonds because then, if it's backed by gold, the BIS, the Bank for International Settlements, which is considered the central bank for central bankers, it's located in Basel, Switzerland, and they ever approved, they issued, they've classified gold as zero risk for banks. Okay, that's quite a bit. So you have an investment that has zero risk. I've never known many investments that have zero risk. Okay, but this is official. So that means that banks do not have to put up reserves against their gold holdings, which makes it really amazing. It's a beautiful asset. They can have there's surplus cash sitting there in gold, and they don't have to put up any reserves for that. So gold is really a fantastic asset. There's no way that this so-called liquid gold, which is a fairy tale, can compete with that. And I mean, gold has been around for 3,000 years. It's been basically money. 3,000 years is a long time for something to keep its place. It's a store of value. If you want to keep your value, yes, it'll have ups and downs, depending on human emotions. The ups and downs in markets, I always point this out, it's not due to events or external factors. Ups and downs in markets are caused by human emotions. It's a fear and greed, fear and greed. That's what makes bull markets and bear markets. And when we issued the forecast in 2020 for the whole decade, which is normal in our business. Everybody in our business has to give the forecast for the decade. And it's that the closest we'll get to is if you look at the 1930s, the Great Depression, and we're going to have something similar. We're going to have all the things that we had at that time. Famines, wars, turmoil, social upsets, turmoils in the street, governments being overthrown by the people, and so on. When you look around, isn't that what we're having? Except now we have a genocide on top of that, which we didn't have since the 1940s. So, it's really something how history, that doesn't repeat exactly, but it rhymes. I think Mark Twain said that history does not repeat, but it rhymes.
Yeah, that's very interesting. Are there any other parallels you would pull out between what we're seeing now and previous times that you think investors should really be aware of?
Well, I think human emotions are always the same. It's you bite it, so that's always the thing. I would advise, and I have advised our valued subscribers. Many of them have been with us for decades. I think we have the greatest loyalty of any subscribership in the financial business. And I would say, just be sure that you know what's happened before and that you don't fall into the same traps. When you see the majority on one side of the fence, you want to be on the opposite side. When you suddenly see that your opinion is the majority opinion, you know you're going to be wrong. So you better see where you were wrong. And that's what we do every time. And, for example, late September this year, we were looking for a good year-end rally to start in November, November, December, as it usually does. And then our work showed in late September, that's not going to happen. We're going to have a big correction in November. And so we said it would change our mind. When the facts change, we change with it. And we're going to have a big correction in November. And probably led by the cryptocurrencies. We had it. And so our work showed that. We use advanced technical analysis. Technical analysis is looking at money flows. What shows you money flows? All the analysts that you see on TV, They only talk about, if they even mention technical indicators, like they mention RSI and MACD and some of these things, but all these indicators don't include the important factor, which is volume. You want to know how much money. When you only look at price, that's all you know. And the algo traders, they can fool you as many times as they want to. Only looking at price. You want to know how much money went into changing that price, whether it's up or down. That's the main thing. So we have developed what we call the Dohmen money flow index. And we showed in all the charts always what for example, the last couple of months, we've been seeing the money flow index declining in all the major indices, while the indices were making new highs. That shows us what's called distribution. Distribution is when stocks are being sold by the big smart money to the naive latecomers. That's what it shows you. Money is going out when the prices are going up. There you go. So the market is under distribution. It's just that simple. So when the market is under distribution, you don't want to be buying. And Warren Buffett figured that out many years ago. I don't think he had a money flow indicator, but he was from Nebraska. I remember I was in graduate school. It was years ago. And there was an article about him. Nobody had ever heard of him, but it was in a magazine called The Midwest Investor, and talked about him starting this hedge fund only with friends and family, and how he invested and so on. He said, he's a smart guy. He's going to go places, and he really did, But he goes on a different value. He goes on a totally value system, which is a very good system. Now, right now, nobody cares about value. The valuations are so extreme in all these stocks. I mean, can you buy stocks like Palantir, 200, 300 price earnings ratio? Nobody thinks about that. Well, it's going up. If it's going up, you got to buy it, No, if it's going up, you should be selling it short, But this is the thing. And you want to look at valuations, If somebody wants to sell you a used car for $500,000, if it's an old junky Ford, would you buy it? You say, no, it's overvalued.
Yeah, I think there's some interesting investor psychology out there right now with that, buying at these very high prices.
Yeah. You turn on financial TV, that's all you hear. Buy this, buy that, buy that. And that's what's going to happen now. You see, in early November, we said, get out of stocks right now. We're going to have a big, juicy correction. Okay. So now we're coming to the next phase of that forecast. We said, okay, so good year and rally is going to start in December. And we gave the reasons why, technically and fundamentally. So see what they had to do, the algo traders, they had to get prices down of the favorite stocks to a level that there were more bargains. Okay, when they force the public to sell, to panic at a bottom, then they go in and pick them up. Okay, they buy these stocks at much lower prices for the next rally that they produce. Okay, I mean, it's sheer market manipulation. We used to say probably 60 to 70% of the market is manipulated. That was for the last, we've been in business for 48 years. But but now I say it's probably 100% manipulated. 100%. Forget all the fundamentals that they talk about. Oh yeah, this happened, and people are afraid of war, and people are afraid of this, and people are afraid of no. People are only afraid. They look at their bank account, and when their bank account is empty, then they start getting worried.
Well, and I think that can be very discouraging for people to hear that the manipulation is so rampant right now. And to be clear, so for you, when you look at that, the way to get around that and actually profit or protect your money is to be contrarian and be on the other side of what other people are doing?
Yes, exactly. And we're making very good money this year. And of course, that's for our subscribers, how we have made the money, but we don't take a lot of risk. People always forget about risk. They say, no, I only want to focus on making money, and no, you want to reduce risk. That should be priority one. Anything that you buy is it risky. If it's very risky, don't do it. Risk is such an important component of successful investing. You don't want to expose yourself to stupid, crazy risk, buying stocks. I mean, that this year, the stocks without any earnings have outperformed by a factor of 10 the stocks with good earnings. I mean, this is incredible. 10 times because stocks with no earnings. And there are actually stocks without sales. And we've looked at those, and they go even up faster. Stocks, can you imagine stocks with no sales? I mean, they don't have a business, and people are buying them.
Well, that is crazy to hear those statistics. And I want to go back to gold and make sure we cover gold because our audience has a really strong interest there. And for the gold price, since we last spoke, the price has gone way up. It's gone to all-time highs. We're in a little bit of a pullback right now. And I'm wondering what you can tell me about what you see coming for the price, because many people are looking at what's happening. They're wondering, can the gold price go lower? Or how long will we stay in this pullback time before we move on to the next leg up? What would you share about gold?
Well, Charlotte, I have to go back to 1980. That was the peak of the last big bull market in gold. Gold went from about $120 to $800 an ounce in 1980. And at that time, everybody was looking for 3,000. And then we came out with sell signal. When it started dropping, went through 694, which was our get out point. At 694, we said sell. It just broke 694, sell. We were going to go into a bear market. We did a cycle study of gold prices over the last 400 years. That meant that you took prices in the US for 200 years, but to get the earlier 200 years, we had to go to Britain. So to get the 400 years. And so we found out that there were certain dependable cycles. And we, based on that, we said, okay, this bear market in gold from 1980 is going to last 20 years. Bear market. People thought it was crazy because everybody was looking for 3,000. And said it's going to be 20 years. And lo and behold, the bottom of that bear market was in the year 2000, exactly 20 years later, which was even amazing to us because cycles are not that accurate. They are usually a few years to the left or to the right. But then we also said in 1980, and that will be followed by a 31-year bull market. And then we even wrote, we have no idea what would cause a 31-year bull market in gold. Well, now we know. Infinite money printing, not only in the U.S., but all the governments are printing money. I just read a headline in an article yesterday that all major German cities are near bankruptcy. German cities are near bankruptcy. I mean, this has never happened before. They're usually very prudent money managers, and all the major cities are near bankruptcy in Germany. Can you imagine what other countries are looking like for France and Italy? What they must be looking at? So, it's terrible. But anyway, so our target is 2030 for gold. Of course, it doesn't give you a price target. Okay, so a price, we can guess like everybody else is doing. So you hear 10,000, 20,000, 100,000, $1 million an ounce. That's BS. Show me your evidence for reaching that price. I always ask people for evidence. Show me the evidence. Show me the evidence that Bitcoin has intrinsic value, and they can't. Even the greatest fans cannot. Okay, so without evidence, I don't believe it. I mean, if we kind of, we have good evidence supporting, which is based, again, on long-term cycles, which can be wrong, and then, we still have good opportunities. But now we see fundamentals for gold really supporting much higher prices for a number of years, right? Because we see that there's, $37 trillion debt in the U.S., Nobody ever would have believed that. I remember years ago, this was probably about 1979. I gave a talk at the YPO, the Young Presidents Organization, and I said, we're going to have a deficit this year of $5 billion. This is unsustainable. $5 billion, and that word billion, that's pocket change, $1 billion, right? Now it's trillions. Yeah.
Yeah,
So,
you're right. That number sounds so small now.
yeah.
Yeah. Well, so I think it's clear then that for gold, the long-term outlook is really strong. I'm wondering if we look a little bit more short-term for gold, people are wondering, all right, there's going to be a next leg higher for gold. What could be the trigger to get it moving again? Is there anything you're looking at in particular? I think keeping in mind that there are so many drivers behind gold right now that could be that next leg.
Here's another thing. For something as good as gold and silver, don't forget silver. You have to take a longer term view. Who is on the short term trading side? It's the manipulators. They're doing the trading. I have a good friend here. He's considered the father of high frequency trading. He started high frequency trading, I think, about 45 years ago. And so he told me that for trades, they would be very happy to make 6 or 7 cents per share profit on a trade. But they do it a million times and it really adds up. And so this is the small margin. So they're not interested in what the market's going to do next week or next month. No, this is all very, very short term. Okay. So now, if they're all very short term, they can enter 90,000 trades per second with their high speed computers. Trades, not shares. Trades per second. How do these people trading with their laptop think they can outperform with their laptop these high-speed computers? Do you think that's reasonable?
No, it seems impossible.
Yeah, you can't. Okay, so that means that you have to shift to an area where they are not. Okay, that's a longer term, and especially when you have a great asset like gold and silver. You have to get away from the short-term view. I used to be a very good short-term trader. I still have an all-time record in an option contest that was traded with real money. We had to actually send the trade slips after reaching a certain profit level. We had to send the copies of the trade slips to the sponsor of the contest. So that was my younger days. But, as time goes on and so on, you get more conservative and so on. And especially the changes that we've seen in the market, most people don't even notice. And we had an uptick rule, which was great in preventing market manipulation. And that came out after the 1929 crash. Joe Kennedy had a team of traders working with him, and they were manipulating stocks downward. They were doing what's called bear raids. They would knock stocks down by just selling the massive amounts short. Okay, and then they made him head of the SEC in 1932 because he knew how to manipulate the market. He said, "We want you to have a way to stop the manipulation." He came up with the uptick rule. He said, if we would have had an uptick rule, we could not have done what we did. And the uptick means that you can only sell short on an uptick of the stock price. Okay? And so that was in effect from 1933 to 2007. Worked very, very well. In 2007, very quietly, no publicity, okay? There was an item, the SEC has done away with the uptick rule. I said, okay, we know the SEC is, they're not working for the public. They're working for other people. And so I said, okay, so something is going to happen next year. The market is going to crash next year. That was 2008. So that was already a tip-off because these algo traders in Wall Street, they wanted to be able to sell short without waiting for an uptick. And that's what they did in 2008. Yeah. Isn't it beautiful how these things work? Yeah. So never make the mistake that the markets are fair. Where billions of dollars can be made in a day by knowledgeable traders. How can we expect it to be fair and to be truthful? No. It attracts a lot of the wrong people. Yeah. And now with the AI, it's make it worse. I don't know.
Yeah, I can.
Yeah. Well, what I think is very strange is that we all know the vulnerability, what can be done with AI. And for example, you see videos here of Warren Buffett and Elon Musk, they're AI videos. It's not these people talking, and sounds like them, looks like them, but it's not them. Okay? So why don't we have a simple law, a federal law, that passed that if AI is used, they have to put it in large letters, large enough so you can read it, that this was produced with AI and it's not the actual person talking. Well, I mean, disclosure. Disclosure is the best rule that you can have. Then people can judge. Do they want to hear it or not? And so it would be so simple to pass. So why don't they pass it if it's so simple? Huh? Why? Yeah. Not because they're not thinking of it.
So we really need to be thinking long term instead of trying to make these short term profits. And gold is good for that, as you're saying. And you also said we shouldn't forget silver. So if we look at your long term outlook for silver, what would you share there? Is it similar to gold in that we've got that 2030 kind of time range for the bull cycle?
Yeah, right now, I mean, we didn't do a cycle study on silver, so I don't know, but they really march in unison. And silver has a lot of catching up to do. While gold was rising here for the last number of years, silver was not. So now the ratio of the gold price to silver has really gone out of the normal. And I think silver has a lot of catching up to do. So I would expect the gains in silver, especially silver miners, to be bigger than that for gold. And the miners have more risk, but so that's why, I like an ETF for the miners because you're diversified across a number of different companies, I don't like anything one company. People always want to go, I want to buy Nvidia, Palantir, and all this stuff, But you're making yourself a target for these manipulators. They manipulate individual stocks. That is the problem. You don't want to be their victim, So you want to be diversified, which is much harder to manipulate for them. So they focus on manipulating a specific stock. Because it was long or short. And they see everybody's long that stock, they manipulate the stock downward. If they see everybody's short, they manipulate the stock upward. That's very simple for them, individual stocks. So I don't like individual stocks at this point because the manipulation, if we had an effective SEC, they would stop the manipulation. They have all the rules necessary. That doesn't need new laws to pass. Manipulation is against the law. We just need somebody to enforce it.
Yeah, well, that enforcement, I think, can be a pretty big issue sometimes. And speaking a little bit about manipulation, I know there's a lot of concern, especially when it comes to silver, about manipulation of the price of the metal and also for gold as well. Is that something that you think about or that you're worried about, gold and silver price manipulation?
I think silver is definitely manipulated and easier to manipulate. Because there have been many court cases with the major banks, where their own traders are manipulating the markets, and then they get fined a couple of $1 billion, which may seem like a lot of money. For them, it's pocket change because they can make that in a few days, with their manipulations. And then they go back right to doing the same thing again, So, they get fined and that's it. The fine is a bargain for them. And so Gold is a bigger market, much bigger. It's a market of the central banks, and I think that that is much harder for them to manipulate. You've got there's certain elements like gold leasing. Most people that buy gold, they don't have any idea what gold leasing is. Gold leasing is a factor in manipulating gold price. They borrow the gold from central banks, and they pay a leasing rate of, let's say, 1% per year, and then they go and sell the gold and start speculating with it. And so someday they're going to have to return that gold that they borrow. But this is also manipulation. The gold leasing 1%. They don't take them much risk. Yeah, no, the precious metals are fascinating. I remember when I was about 24 years old, I started. I wanted to trade the markets in high leverage because I had very little. I think I started with $400, and I said, the SEC required about 70% margin, and I knew that in Switzerland they only required 10%. So I flew to Switzerland and started trading there. And so, when you're young, you do crazy stuff like that. So we're there in the big gallery, all the big American brokerage firms had spectator galleries in the back. You could see the ticker tape, you could read the news wire and so on. And you really met some interesting people who were also trading their own money. And usually the wealthiest one person from France who was related to the Rothschild family, and another one, Hercules. He was the silver trader from India. He was an Indian, and his silver had the big first run up from $1.25 to $2.90, which was used, and he was selling it short all the way up, and he was sweating, because he was losing so much money. And then the manager gave him one day to close out the shorts, and because of the big margin calls. And that day, silver broke. And he was convinced. He said, there's so much silver in India. Every household has silver, and they're selling it like crazy now, because silver is their replacement for a bank account. They don't trust the banks in India. Okay? So he said, it's silver. And then, just in time, silver broke and he was saved. So these are really interesting experiences you can have as a trader, trading your own money.
Yeah. Great story. And as we're getting toward the end here, I have hopefully it's a fun question. We'll see if it's a fun question. It's one that I'm trying to ask people, everyone I speak to, as we get toward the end of the year. And it might be a little bit too short term for you, but I'm wondering what you think the top performing asset of 2026 will be. It could be a commodity or otherwise, whatever you're thinking right now.
It looks like gold might be it.
Yeah, could be gold.
Yeah,
I think that's a fair answer.
Probably there's a chance that silver would outperform.
Definitely, yeah. I think that could happen.
Yeah.
All right. Well,
but the important thing with these two metals is, in my opinion, at least, the risk is so much lower than with other investments. And look at I love NVIDIA as a company. They've done a fantastic job. And in my opinion, they have a moat around their technology. They do everything from making the chips, the software, everything. And so this is the premier company in AI. But still, it has a very high valuation, and they will knock it down from time to time. But if anybody wants to diversify into technology, that is one company I would buy. Anything else, these companies selling at these very high PE ratios, 100 to 1, 200 to 1, 300 to 1, I wouldn't touch. Yes, you can make a lot of money, but you can lose a lot of money too. And I'm always more worried about the money I can lose than the money I could potentially make.
Well, I think that's a great place to wrap it up, unless you had any final thoughts you would leave investors with.
Well, I think one way to keep track of what we're thinking and what we're doing, like this very important change at the beginning of November, we do have the Wellington letter, which we publish twice a month, usually, and it's 25 pages, single spaced. So you get about 50 pages of research, well done research, and contrarian views of the markets, things that you don't hear on TV. And so that is a good place to start to educate yourself. Most people don't like to read anymore, and especially younger people. There's such a big mistake. Reading is the most important thing you can do. There's no other way to get knowledge than by reading. I tell my 5 grandchildren, I always say, if you want to be a leader, you have to be a reader.
Well, I love that. I think that is the point that we will finish up on today. This was really great. Hope to have you back once again in 2026, but thank you so much for coming on today.
Thank you for the opportunity. Okay, have a very nice New Year. Okay.
You as well.
Bye.
Once again, I'm Charlotte McLeod with investingnews.com, and this is Bert Dohmen.
Thank you for watching. If you like this video, make sure you hit the like button and subscribe to our channel. We'd also love to hear your thoughts, so leave us a comment below.